Hi, I'm Shane with Atlas CFO, and today I'm going to talk to you about why financial projections matter if you're running a commercial construction business. In other words, if you're relying on only your historical data to make your financial and strategic decisions, you may be missing out on an important tool, and I'm going to explain to you why. So first off, why listen to us? Well, in a nutshell, we're accountants who became contractors, who then became accountants again, who help contractors. We are CPAs. We have a CCIFP and an elite alumni on our staff. We all have public accounting or private equity experience or both. We all grew up in and around our family construction businesses. So it's in our blood. We know and love the type of people that go into construction, and they're special to us, so we want to help and serve them. We're former CFOs, COOs, and owners of a mechanical contractor, and all of this has led us to develop a system and a method that we still use to this day to help our clients. A key part of that system is financial projections, so that we can help clients make clear, faster decision making. I'll show you some case studies to illustrate what I mean. And you'll notice a couple things in these examples. They all showed increased revenue, an improvement in the bottom line, and they all improved their balance sheet, their working capital, debt to equity ratio, and equity. So this one, you can see we had quite a bit of growth from 17 million to 41. Gross profit stayed about the same, even in that much of an increase in volume. Working capital increased tremendously to $6 million. Total assets grew, debt to equity shrunk, and equity itself increased. Another example, again, so you see improvement in revenue, margin stayed the same, net income improved, and you can see they improved their balance sheet metrics, working capital, total assets, debt to equity, and equity. Another example, again, substantial growth in revenue with improvement in gross profit. Net income ticked down just a bit, but they made improvements in working capital, total assets, debt to equity stayed about the same, even with that much growth, and again, improvement in equity. In this example, again, you can see quite a bit of growth in revenue. Gross profit ticked down just a hair, but net income improved. Working capital, total assets, equity all improved greatly, and debt to equity actually decreased. And finally, another example of just a little bit of clarity and forward-looking metrics, and they were able to stay on path, substantially grow revenue, gross profit, net income all improved greatly, and the balance sheet had a complete turnaround. So just some quick examples of what you can do with the power of projections and forward-looking metrics. So now that we've seen some case studies and examples, what are we going to cover today? Well, I'm going to cover 6 things. 1, the difference between historical and future data, projections for goal setting and financial planning, how you can use projections to make sure you're setting the right goals and tracking to hit those goals, and a little thing we call VPO, volume, profit, and overhead, how you can use projections to reduce or manage your risk and move the needle on what matters to having a healthy business and a healthy balance sheet, how you can use projections for better cash flow forecasting, how you can use KPIs with projections to know where you're at quickly and where you're headed, and then a quick discussion on our solution and why it works so well. So first one, historical versus future data. Well, historical data is something we're all familiar with. It's just stuff that's already happened. So you're used to probably getting your monthly financial reporting package for the prior month or the prior year. Meanwhile, you're always working ahead. You're always into the next period, and you'll wait to see if the results caught up. Well, in this case, we're talking about monthly financials based on the percent complete method. If you're a commercial construction contractor, with the length of time our jobs take to start and complete and the ups and downs in billings, it's critical that you have that. So if you do, one of the strengths of historical data is it provides accurate information on how you've done. It's necessary for key relationships, your bank, your surety, maybe a pre-qualification for a new client or a new relationship. You can use it for decision making because you do get to see the result of your decisions based on at that point in time. So you can look back and see if it worked or did it get you where you wanted. You can use historical data for taxes, for managing taxes, for tax planning. And you get an overall look at your current financial health because, again, it's historical. It's in the bag. It's a done, completed month or a year, and you can see how you did. The limitations with that, they don't create future performance or look at future performance. So you've got backlog, you've got budgets, you've got manpower schedules, but your historical data, financial data, doesn't help you determine necessarily what your future is going to look like. So future-oriented data, financial projections, what are those? Well, basically that is projecting or forecasting your expected future performance based on a combination of your historical data, forward-looking info, such as your backlog, your burn rate, or schedule on your work, and budgets. So you can take all of that, and with the right mix and the right tools, you can put that in the hopper and see what does it look like. Where am I headed? The strengths of that is it allows proactive decision-making. In other words, you get a look at where you're going to be at a point in time, and you can decide, is that where you wanted to be? Does that have you on track for your goals, or do you need to make a different decision? It allows you to do what-if planning almost in real time, because as soon as you have a new set of variables, a new job, change in job, a new change in expenses, you can plug those in, run them through, and see if you need to make the next set of decisions or if you're on track. The limitations, well, you've heard the phrase garbage in, garbage out. Well, that refers back to what I mentioned about percent complete financial statements. If you're a commercial contractor and you don't have good, accurate financials, and a WIP on percent complete, job schedule, in other words, is critical to that, then you probably have garbage. You're not accurately measuring your earned revenue and your results. So that's a big limitation. If you don't have the right data, you don't have the right ability, the right forecast. Another thing, projections are based on estimates. We all are used to putting estimates together to get the job, but the key piece of this is then tracking your actual performance to your estimates. If you have bad estimates and no tracking, you can't really do projections because you really don't know what track you're on. So garbage in, garbage out, and accurate estimates would be the two limitations of future-oriented data. So let's talk about what you can do with financial projections. And the first thing is goal setting and strategic planning. So if you have financial goals, if you've identified what you want your company to look like or to become, it is a great way to approach forecasting. In other words, maybe you have a net income goal. Maybe you have a percentage, a bottom line you want to hit over 1 year, 3 years, 5 years. Maybe you have where you want your company to be. What is a healthy bottom line for you? What level of financial strength do you want for your company? In other words, what do you want the balance sheet to look like? I've mentioned several times working capital, debt to equity, current ratio. Those are all balance sheet measures. If you have strong ratios, the balance sheet that has a lot of health, a lot of cash essentially, then you can support growth. You can do some planning to do more than just get the next job and see how it turns out. And then finally, what are your personal wealth goals? Construction is a stressful, hard business. We don't want to do this for practice. At the end of the day, we want to have something to show for it. So where do you want your company to be, and how do you want to be able to reward yourself for all of your years of blood, sweat, and tears, basically? Volume, profit, overhead. This is a really good one to measure with projections. This is what moves the needle. When I say volume, I mean revenue. So the key there is how much do you need and when do you need it? You may have a job schedule with a bunch of uncompleted work, but when does that work fall to revenue? When do you earn it? And is it enough? And when do you need more? Profit. We're talking margin or job performance. And this is really what drives everything. If you can't perform on your jobs, you can't cover your overhead fast enough, and you aren't going to get to a profit for the year fast enough. Overhead, knowing when your break even is. In other words, when did you cover your overhead for the year so that you can start making money and add to the bottom line? If you have 11 months in the year that it takes you to break even, that gives you 1 month to try to add to the bottom line and actually have a positive year. The sooner you know what your coverage looks like, what your profit is trending for your business, and how much revenue you have, the sooner you can get to where you're making net income and building a healthy balance sheet. Cash flow management. So projections are great for company level cash flow management, especially if you're growing. And why that is, well, if you take all of your backlog of work, your payment cycle, in other words, cash cycle, when you bill and get paid, when you pay, how much you owe. You can see how much you have at certain points in time. See, is it enough? Do you have the cash flow you need when you need it so that you can ramp up that work or make a tax payment or fund a debt payment, things like that? And if you're in a situation where you need a line of credit, well, how much do you need? For how long? How soon can you pay it back? So these are all great cash management metrics you can track with projections. Key performance indicators. Everybody likes the acronym KPI. Well, there's several you can track with projections, and several of these that we track as well. Break even. Well, how fast did you get to break even? Because the sooner you have break even, either on a monthly basis or for the year, the sooner you can get to positive net income. Gross profit. How much profit are you making? What is your trend for gross profit? Once you factor in how jobs are doing, how the next set of jobs are coming on, what you had to bid them at, how your field labor's performing, what does it look like? Is it where you need it to be to hit the year that you want to have? Overhead. We've all seen a lot of inflation in the last several years. Some of it's insidious. You may be looking at overhead and maybe it creeps up a little bit every month. Well, by the time you get a year, 2 years down the line, it could be substantially higher. So using projections to track overhead as a KPI lets you see where you're headed and get ahead of any major surprises. Current ratio. That's basically how many dollars of cash do you have to pay a dollar of bills, of debt. Managing that is a great KPI, something you can do quickly and easily with projections because you can see not only where you were at the prior month, prior year, but where you headed. What is all of your effort going to do at year end for your ratios and your balance sheet health? Same thing with debt to equity. You can calculate debt to equity every month, and then by using projections, you can see if it's trending in the right direction. Return on assets, return on equity. You only have a year to make your numbers. So what kind of return are you getting for the dollars of assets your business has or the dollars of equity? And is it sufficient? Is it a healthy return or not? And using that as a KPI so that you can see where you're headed is a great way to manage the strength of your business. And there's working capital. There's that word again. Cash. It's a great KPI. How many days of cash? How many months of overhead do I have in cash? Various ways to look at working capital in cash. But essentially, do you have enough to fund the growth that you've got ahead of you? And is it going to be sufficient? What's the mix? Are you going to need a mix of cash, a mix of debt, a mix of a line of credit? For what? How long? When can you pay it back? Again, how healthy is your cash? It's a great KPI to track as a forward-looking indicator. Backlog to goal. So backlog to goal, let's just say you want to be a certain size contractor. Well, based on how long it takes for projects to get signed, get started, get out of the ground, and maybe for you to get to your portion of the work, you may have a sufficient amount of backlog, but is it going to be the right kind at the right time to get you to your revenue goal? So tracking that is critical. So I've thrown a lot at you. I mentioned a lot of things you can track with them. Maybe you're a spreadsheet kind of person and you like to do it all manually. Well, I'm lazy. I like to have it done as quick and as easy as possible because I want to get the information to get to the next set of decisions. And so that's why we built the tool that we did. It uses info you already prepare, or you should be preparing. It's an income statement, balance sheet, and a WIP report or job schedule. Again, on the percent complete method, because if you're a commercial contractor, it's key. Our tool is simple to use. Plug this data in. You can refresh some parameters, some assumptions, and you've got a look at where you're headed. And it's really quick and fast because I want to get to the important part, which is scenario planning. It allows you to game your scenarios to see what impacts changes in your VPO, volume, performance, and overhead may have to your results the year ahead of you. So keying stuff in is not where you make your money, it's making decisions. So getting to that point where you can see what is ahead of you and see what you need to do next is what's critical. And that's why we have the solution we have, because you can track your goals, see where you're heading, and know before you get there if you need to make a new decision. So why does it work? Well, once our clients use it and once they see really a few things. One, what are they capable of? Whether it's VPO, whether it's sales effort, whether it's manpower, subs, what kind of capacity they have, what does that generate in balance sheet health? How healthy can their company be? How profitable can they be? And what's the reward or the end of the year look like? Well, once they can see that and get to some quick strategy and decision making, they get to work. And you saw in the case studies at the beginning, when you have information, you can really grow. If you have the right dedicated team, it can be just the tool they need to unleash all of that power and that performance. So how do you get started? Well, if you are interested in working with us, interested in talking about how you can get some help or improvement in your processes and your visibility, we have a BCFO package. It has an onboarding process that's usually an intense 12 weeks where we go through everything in your processes, help you set things up or refine the accuracy of what you have. We help you with the WIP, how to set up the WIP and the job schedule, how to read it, how to translate it between the key partners, which are estimating, project management, and accounting, how to get accurate financial statements and timely financial statements. We use a Teams connection or channel so that we can securely trade information back and forth, answer questions, and be available as you have things come up. We use our projection model to cover the things that are important to us. And we do a minimum of 2 calls a month. Sometimes they're more, sometimes it's only a couple times. It's not our goal to overwhelm you with a to-do list. It is to help you bring your processes and your information forward so that you can get to the fun stuff, which is scenario planning and making good business decisions. We also offer just a strategy only with our AGM. It's our tool we call the AGM, Atlas Growth Model. You get to use the projection model. We have a call to go through and game financial decisions and help you with strategy. Now, to do that, you need to have, it's critical to have accurate monthly financial statements and a WIP on a % complete basis. You need to believe your numbers because, again, as I mentioned earlier, garbage in, garbage out. We can't help you if you don't have a believable, accurate numbers and a good system for getting them. But if you do and you're interested in our help or reaching out just to ask questions, you can either go to our website, atlascfo.com, or you can shoot us an email at hello@atlascfo.com. And if you have a system, if you've got a good team and you're using a different tool, whether it's spreadsheets or a different process, if you have the information, share this with your team. It maybe will give them some ideas to think about. Maybe you're not getting some of these metrics on a regular basis, but you could be. Maybe it would help your decision making. So hope you found it useful. On behalf of myself, Melissa, and the team at Atlas CFO, I want to say thank you, and here's to a great year. Take care.